I spent the last week digging through every line of Alphabet's Q4 and full year 2025 earnings, revenue, margins, cloud backlog, spending guidance, all of it. And what I found, it's a company that just beat earnings by 7%, grew cloud revenue 48%, and has a locked-in backlog of $240 billion. You'd think the stock would have done well, but it dropped 9% after the report. That's why in this video, I'm breaking down exactly what happened, starting with the numbers that Wall Street loved, then the one line item that just spooked the market, and finally, two growth catalysts I think most investors are completely underestimating today. Because if you're holding Alphabet like me or thinking of buying, you need to understand what's actually going on before making your next move. Now, if you're new to the channel, hello, my name is Rick Orford. I'm a Wall Street Journal best-selling author. Been trading since 1999, and no, I'm not a financial advisor. That is a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. Now, before we begin, I wanted to thank Seeking Alpha for the data in this video. If you'd like to follow along, go ahead and scan this QR code or click the link in the description. They'll give you access to a free trial and a nice discount just because you used my link. So let's start with the earnings because they were actually much better than most investors realized. Alphabet released its fourth quarter and full year 2025 earnings on February 4th, 2026, and the numbers, they were pretty solid. Fourth quarter revenue came in around $113.83 billion, and diluted EPS hit $2.82 a share, all beating estimates by about 2% on revenue and nearly 7% on earnings. Now, for the full year, Alphabet pulled in just over $400 billion in revenue, roughly in line with what analysts expected, and reported diluted earnings per share of $10.81, also beating estimates by just over 2%. But here's the thing. Despite all of that, the stock dropped about 9% since the release. And I got to get into exactly why that happened, but only in a little bit. First, I want to dig into the numbers further. Now, Alphabet's fourth quarter revenue did rise 18% to roughly $113.83 billion, and that was driven mostly by the Google Services segment. But the real standout here was Google Cloud. That grew 48% year over year. I mean, that's a massive jump from the 34% growth rate we saw in the previous quarter. I mean, this is the kind of acceleration that, well, clears up a lot of the uncertainty that people had about Google Cloud's momentum going into 2026 and 2027. Gross profit climbed about 21.8% to around $68 billion, with gross margins expanding to almost 60%. So Alphabet's keeping almost 60 cents of every revenue dollar after covering its direct costs. And that number, it's growing. I mean, that's a good sign, right? Operating income also rose 16% to $35.93 billion, and net income jumped nearly 30% to $34.45 billion. And if you notice, net income is actually growing significantly faster than revenue, and that's because of stronger operational leverage. More of that revenue is flowing to the bottom line compared to the same time last year. Now, for the full year, revenue rose 15% to $402.83 billion. Gross profit increased 17.8% to $240.3 billion. And margins expanded 1.4 percentage points to almost 60%. Operating income rose nearly 15% to $129 billion. And net income jumped 32% to $132.17 billion. Again, bottom line growth here is outpacing top line growth. So Alphabet is running a very tight ship, and it's being able to create more net income on every revenue dollar that they're making. On the balance sheet side, Alphabet closed the year with $126.84 billion in cash and marketable securities against just $46.55 billion in long-term debt. It's also worth noting that they did issue $24.8 billion worth of senior unsecured notes back in November of 2025. So after netting out all of the debt, Alphabet's still sitting on roughly $80 billion in net cash. I mean, that is an enormous financial cushion. But here's something that many investors are overlooking. That cash pile, isn't just sitting there. At current interest rates, $80 billion is generating its own $1 billion in annual interest income, which is actually one of the reasons why net income ended up exceeding operating income this year. Management also declared a quarterly dividend of 21 cents a share that's payable on March 16th, 2026. Now, for the first quarter of 2026, they are expecting a foreign exchange tailwind on consolidated revenues. And then, this is the big one. CapEx spending plans in 2026 are expected to land somewhere between 175 and 185 billion. About 60% of that is slated to go towards servers, and the rest is slated to go towards data centers. Now, if we remember, in 2025, CapEx spending came in around $91.5 billion. So we're talking about roughly doubling capital expenditure in one single year. And that right there was the primary reason the stock dropped after earnings. Now, I want to pause here because that number does deserve a little context before I move on. Yes, it is massive, but to understand whether it's justified, we do need to look at where the money's actually going and what it's going to build and what it's going to go towards. So for that, let's talk about the stock's valuation and what the market is really pricing in right now. At the time of recording, Alphabet's trading at roughly $303 a share. Over the last 6 months, the stock is up about 50%, and over the last year, it's up about 63%. And if you zoom out 5 years, you're looking at about 190% in returns. So while a lot of investors who doubled down on AI are licking their wounds right now, so to speak, Alphabet's returns speak for themselves. And I understand why some new investors might feel like this stock has run too far, too fast. I mean, just a couple of months ago, I wrote a piece that was published on Seeking Alpha about Alphabet being the most undervalued stock in the Magnificent Seven lineup. And I was very vocal about it. I guess I was right, not that I want to do a victory lap. But today, Alphabet has one of the highest premiums in that same lineup. And I'm glad that I didn't sell through all of the turbulence. Today, Alphabet's forward PE sits around 26 times, about 54% above the sector median. So is that expensive? Well, in absolute terms, yes. I mean, it trades at a premium, but I think this premium is earned, not handed out. I watched Google trade below the sector median despite having rock-solid fundamentals. I mean, when a company this size is growing revenue 18%, net income 32%, and holding its dominant position in AI, and not to forget running a cloud business at 48% growth, and building out what might be the most comprehensive AI business in the industry, paying above median, well, kind of makes total sense, don't you think? And here's my bolder take. Alphabet's valuation keeps climbing as it continues evolving into a true AI superpower. I mean, think about what they actually have here. I mean, practically unlimited data to train their AI models on. In-house AI infrastructure through Google Cloud. And remember, their own custom AI chips, tensor processing units, or TPUs, deployed within their own infrastructure. And they're actively working to bring nuclear power online to keep their data centers running. If there's one company with a structural edge to win, at least in the AI arms race, don't you think it's Alphabet? Now, I think the real risk, though, isn't the valuation being too high, at least not today. I think it's the possibility that growth slows a little before these enormous capital investments, the capital spending, finally starts paying off. But even if that happens, investors with a longer enough time horizon, I shouldn't really be losing any sleep over it. And here's something the bears even tend to forget. Even if hyperscalers are overspending today on AI, and even if the market suddenly wakes up and decides AI isn't as transformative as we may have thought, which for the record I think is very unlikely, Alphabet still has one of the widest moats in the business. Because even today, most of Alphabet's money still comes from ads, not from cloud, not from AI. And when that changes, well, I think a lot of those bear cases are just going to completely fall apart. At 26 times forward earnings for a company growing this fast, sitting on $80 billion in net cash, sure, it's not cheap by traditional standards, but it's absolutely justified by the fundamentals and where the company is headed. So now that we've established how strong the foundation is, let's talk about what could push the stock even higher because the real upside, I think, is still ahead. I mean, to me, the most immediate catalyst is the partnership between Apple and Gemini. In January, Apple officially chose Gemini to power a complete overhaul of Siri and Apple Intelligence across 2.5 billion active Apple devices. Apple's paying roughly $1 billion a year under a multi-year contract, and this is where things start to get really interesting. Gemini will essentially be the engine running Apple's entire AI strategy, similar to how Microsoft Copilot runs ChatGPT under the hood. And if we remember, ChatGPT was running on Apple. So at least it was running their Apple Intelligence until now. So Apple saying we chose Gemini, to me, is what they're really saying is that Google built a reliable enough or a more reliable AI model for consumer-facing applications. I mean, to me, that's an endorsement that money genuinely can't buy. On top of that, this partnership could give Alphabet a revenue share from product discovery or purchases that are made through Siri. And that revenue share could end up being worth far more than the $1 billion annual fee over the long run. So from a competitive standpoint, this is a major win over OpenAI, which was said to be the front runner in this very same deal. I mean, it says a lot, right? I mean, remember, ChatGPT is still widely considered the most powerful large language model on the market. What I see happening over time is that Gemini gets pre-installed across every smart Apple device. That kind of distribution channel, that's kind of hard to replicate, isn't it? That $1 billion annual fee adds roughly $5 billion in revenue over a 5-year period, though that actual contract length wasn't disclosed. So 5 years is just my estimate. But beyond the direct fee, the indirect value of this deal, as Gemini gets woven into the daily routine of hundreds of millions of Apple users, could add another 3 to 7 billion annually by year 3. And applying Alphabet's net margins around 33%, that direct deal alone could generate about $330 million in annual net income. And that indirect revenue at scale, well, I mean, it alone could add another $1 to $2 billion to the bottom line by 2028. I mean, some people will say these are rounding errors for Alphabet, but I actually think those estimates are actually quite conservative because they don't account for the compounding effect of Gemini becoming the default AI engine that's running across Apple's entire ecosystem. And that leads perfectly into the second major growth driver. That's Alphabet's Google Cloud. Cloud revenue increased 48% year over year to $17.7 billion in the fourth quarter, with operating margins hitting 30.1%. That's impressive for a cloud business that was barely breaking even just a few years ago. But what really caught my attention was the cloud backlog. It hit $240 billion at year end. That's a lot of money, don't you think? I mean, it's up 55% from the previous quarter and more than double from a year ago. Now, the backlog is just the total value of contracts that customers have already signed but haven't yet started to pay out yet. I mean, this is the revenue that will show up in Alphabet's income statement over the coming quarters and years. It's essentially just future revenue already clocked in. Now, the growth here is being driven primarily by AI infrastructure contracts with major or other major players that include Meta, Anthropic, and OpenAI. The Gemini API is now processing more than 10 billion tokens per minute, up from 7 billion last quarter. That's real, sustained enterprise AI adoption at scale. Now, over the next 24 months, my outlook is like this in this segment. I mean, if Google Cloud maintains a growth rate of just say between 35 and 40%, remember, this is below the current 48% pace. Quarterly cloud revenue will reach around $36 billion by the fourth quarter of next year, 2027. At current operating margins of 30%, that works out to somewhere around $10 billion in quarterly operating profit by late 2027. If you annualize that, I could see Google Cloud on its own generating about $40 billion in annual operating profit by the end of 2027. For context, the entire Google Cloud segment generated only $8.9 billion in operating income for all of 2025. So we're potentially looking at a 4x to a 5x increase in cloud profitability within just 2 years, all backed by contracted backlog and observable growth trends that are already in motion. And that brings me to the big question. Is Alphabet stock a buy today? Well, I've owned Alphabet stock for many years. My take is that it's still undervalued relative to where it's heading. The company is quietly becoming the go-to AI infrastructure provider for the entire AI industry, yes. And that includes companies that compete directly with it. OpenAI, for example, has been running ChatGPT on Google Cloud infrastructure despite being one of Gemini's biggest rivals. And here's a useful parallel. During the cloud computing boom of the 2010s, Amazon's AWS became the dominant infrastructure provider. And it literally drove Amazon's operating income for years, even as dozens of cloud-native startups competed at the application layer. And Google Cloud looks like it's on a similar trajectory, but with some extra advantages that are sweetened on top. One of the top AI models, the most dominant search engine on the planet, the largest video platform in the world, and now a major distribution channel through Apple. There's a lot to unpack when you're talking about Alphabet's competitive moat. Yes, $185 billion in CapEx spending is a very big, scary number, and I completely get why the market reacted the way I did. But to me, the fear seems to be rooted in the assumption that all of this spending is just a gamble on an uncertain future. No, it isn't. No matter which AI infrastructure provider you look at, demand is outpacing what providers can actually supply today. They're sold out. So that's my take on Alphabet. What about you? What do you think about their CapEx spending guidance? Is it worth the recent sell-off, or is this sell-off a gift? Let me know your thoughts in the comments below. And of course, while you're there, if you found the video helpful, don't forget to like and subscribe because it helps others find the video, it supports the channel, and it makes sure that you don't miss out on my next deep dive. Well, that's it for me today, at least in this video. Thank you so much for watching, and I'll see you next time.